If you're investing on a tight budget, 50 bucks a week, maybe 100, these 5 mistakes don't just hurt, they multiply. Because when your account is small, every bad decision steals something you can't easily replace: time. And I want to start with a picture you'll recognize. It's Sunday night. You're doing the responsible thing. You paid the bills. You put anything into your brokerage app. Maybe it's $40. Maybe it's $75. Maybe it's whatever's left after groceries and gas and that one unexpected expense that always shows up like it owns your life. You tell yourself, it's not much, but I'm starting, and you feel that little spark of pride. Then you open your phone. A headline about an AI stock changing everything. A clip of someone bragging they doubled their money in a week. A thread about the next big thing. A chart that looks like a rocket ship. And suddenly, the responsible plan feels slow, almost embarrassing. So you make a tiny adjustment. Just one trade, just one smart risk, just one cheap stock that's down 70%, so it has to bounce, right? And that is exactly how low-budget investing gets quietly ruined by decisions that feel small in the moment, but become catastrophic when you repeat them for months and years. Benjamin Graham's entire philosophy is basically a system for preventing that slow-motion self-sabotage. Not with magic, not with prediction, with something far less exciting and far more powerful: discipline, valuation, and defensive thinking. By the end of this video, I'm going to give you a simple low-budget blueprint you can run almost on autopilot. A Benjamin Graham-style setup built for real-life retirement, for the middle class, for people who can't afford to be wrong for fun. But first, you need to spot the 5 mistakes that are draining small portfolios the fastest, especially in a market that's loud, addictive, and engineered to push you into action. Quick note, this is educational, not personal financial advice. Your situation matters, but the principles are timeless. Now, mistake number 1. A low-budget investor's biggest temptation is also the most dangerous: trying to catch up with a high-risk shortcut. Because when you start small, you do the math in your head. If your account is $800, a 10% gain is $80. That feels underwhelming. But a 50% gain? Now we're talking. So you start shopping for 50% gains. And the market happily provides a showroom full of them. Meme stocks, penny stocks, highly speculative biotech, crypto coins with a mascot, zero revenue story stocks, and of course, whatever corner of the AI hype cycle is trending this week. Here's the problem. Graham would look you in the eye and say, if you're buying something primarily because you hope other people will pay more for it soon, you're not investing, you're speculating. And speculation isn't automatically evil. It's just a different game, a game with different rules. And the rule that destroys low-budget portfolios is simple. Volatility is not just emotional pain. Volatility is a liquidation event waiting to happen. A big portfolio can take a hit and keep going because it has cushion. A small portfolio takes a hit and it changes behavior. It changes your identity. You start checking the app more. You start doing something. You start revenge trading. You start selling at the exact moment you promised yourself you wouldn't. You don't just lose money. You lose your process. And the worst part, the market will reward speculation just often enough to train you like a slot machine. You'll get the occasional win, the occasional 30% pop, and then you'll scale up the same behavior right into a drawdown that wipes out a year of contribution. Graham's defensive mindset starts with a question that sounds boring, but it's the line between investing and gambling. Am I buying a business or am I buying a story? If you can't explain in plain English how this business makes money, why customers keep paying, and what happens if the economy slows down, you're not investing, you're renting a narrative. So what's the correction, especially on a low budget? You build a core that doesn't require genius. For most people, the smartest low-budget foundation is broad diversification at low cost. Think total market or S&P style. Index exposure through low expense ETFs or index funds. That's not hype. That's not sexy. That's not going to give you a screenshot-worthy week. But it aligns with Graham's defensive spirit. Your baseline should not depend on you being smarter than the crowd. It should depend on you being consistent. Then, only then, if you want to add individual stocks, you treat that as optional. You don't treat it as your retirement plan's engine. And if you feel your ego fight that, good. That friction is your instincts admitting the truth. You wanted excitement, not security. Now, mistake number 2 is where people lose money without realizing they're losing money. It's invisible. It's death by 1,000 small cuts. Low-budget investors love the phrase, zero commission. It feels like the market finally stopped charging admission, but the market always charges. Sometimes it's just not labeled as a fee. Here are the leaks. High expense ratios hiding inside fancy funds, constant trading that triggers spreads and slippage, chasing the latest ETF trend, panic selling, and rebuying, and especially in taxable accounts, short-term capital gains taxes that punish you for acting like a day trader. Let's make this concrete. Imagine 2 people invest the same amount for years. One keeps costs low and trades rarely. The other pays an extra 1% a year in fund expenses and churns the account with just small trades. That 1% doesn't sound dramatic, but compounded over decades, it can mean the difference between I can retire and I'm working longer than I planned. Graham was obsessed with the math that most people ignore, the math of what you keep, not what you make. He didn't need fireworks, he needed reliability. So the correction is painfully simple and powerful. 1. Make cost a first-class variable. If you're using funds, understand the expense ratio. Lower is usually better, all else equal. 2. Reduce churn. Most portfolios don't need constant activity. Activity feels productive. It feels in control. But for the average investor, it's usually just paying tuition to the market. 3. Use the accounts that reward patience. If you're in the United States, that means understanding the basics of 401ks, especially employer match IRAs like Roth, and other tax advantage structures that exist specifically to help long-term investing. You don't need to memorize every rule today. You just need to respect the principle. Taxes and fees are part of your risk management. And here's a rule of thumb you can carry around like a pocket knife. If your strategy requires you to be right quickly, costs will eat you alive. If your strategy allows time to work, costs shrink into the background. Now, mistake number 3 is sneaky. It's the one that feels responsible, intellectual, even value investor-ish. It's also where a lot of people get trapped for years. The mistake is thinking cheap means safe. A low-budget investor learns one big concept: buy low. So they go bargain hunting in the stock market like it's a clearance aisle. Low P to E, down 60%, oversold, undervalued. Everyone hates it, and sometimes that actually works. But Graham would warn you, a stock can be cheap the way a sinking boat is in Graham and Dodd's framework. Price and value are not the same thing. Price is a number on a screen. Value is what the underlying business can reasonably produce and protect, given its assets, earnings power, and financial structure. If you buy something just because it looks cheap relative to last year's price, you might be buying a company with too much debt, shrinking margins, a deteriorating competitive position, or accounting issues that never show up in a hype-filled headline. This is the classic value trap. It looks like a bargain until it turns out it's not. Graham's defensive investor checklist wasn't a vibe. It was a filter. He cared about financial strength and stability because those are what keep a business alive long enough for value to be realized. So what does the correction look like for a normal person, especially on a low budget, without turning your life into a CFA exam? You keep it simple. You ask a few questions that protect you from the most common traps. How leveraged is the company? If debt is high, your margin of safety gets thinner because creditors get paid before shareholders. In a downturn, debt doesn't care about your optimism. Does the company have the liquidity to handle stress cash, current assets, the ability to pay near-term obligations? Does it have a history of consistent earnings over a cycle, not just one good year? Is the business understandable enough that you can describe what could realistically break it? And you don't need perfect answers. You need red flag avoidance. You're not trying to be brilliant. You're trying to not be destroyed. Here's a powerful way to internalize a low price. Is not a margin of safety by itself. A margin of safety is a discount to a value you can justify, plus a balance sheet that can survive reality. Now we move into mistake number 4. And this is the one that looks sophisticated on the surface. Buying great companies at any price and calling it long-term investing. You've heard the line, it's a wonderful business. That may be true. But if you pay too much, you can still get poor returns for a very long time, even if the company succeeds. This is where people confuse quality with value. In a market obsessed with narratives, AI, cloud, the next platform shift, investors start acting like price doesn't matter. They tell themselves, I'm not trading, I'm investing. But what they're really doing is outsourcing valuation to optimism. Graham's world doesn't work like that. He believed the future is uncertain, and that uncertainty should be priced in. He didn't pretend he knew what a company would earn in 10 years with precision. He demanded a buffer, an error cushion, because life is messy and markets are moody. That buffer is the margin of safety. And you can understand intrinsic value without building a 17-tab spreadsheet. Intrinsic value doesn't require complexity. It requires humility. Here's a simple, Graham-aligned way to think about it. You estimate what the business can earn under normal conditions, not the best-case scenario, not the hype-case scenario. Then you ask what you'd be willing to pay for those earnings if you were buying the whole business, not just a ticker symbol. You think in ranges, not single numbers. You assume you can be wrong. Then you demand a discount that makes being wrong survivable. That's it. And if you can't estimate value with enough confidence to demand a margin of safety, Graham would likely say, then you don't have to play that game. The defensive investor is allowed to be selective. You can choose the broad market. You can choose high quality, diversified exposure. You can choose simplicity, because the most expensive mistake is not missing a rally. The most expensive mistake is buying something you don't understand at a price that requires perfection. And here's where low-budget investors get hurt most. They dollar-cost average into anything that feels famous, without checking valuation. DCA is a tool. It's not a magic spell. It works beautifully when applied to broad, diversified assets over long periods. It can be dangerous when applied to a single, overvalued stock whose price was inflated by enthusiasm. So the correction here is a personal rule. I don't care how great the company is if I can't make a conservative case for value and still demand a discount. I'm not buying, not because it won't go up, because I refuse to require luck. Now we arrive at mistake number 5. This is the one that doesn't feel like an investing mistake until it's too late. It's the mistake that turns normal people into forced sellers. It's the mistake that makes a market crash not just a chart, but a life event. The mistake is building a portfolio with no defense, no cash buffer, no bond allocation, no plan for job loss, medical bills, car repairs, or the simple truth that recessions tend to show up exactly when you least want them. People hear cash is trash. They hear bonds are dead. They hear you're young, take risk. And they go all in, every dollar, maximum exposure, no cushion. Then Mr. Market does what Mr. Market always does. He changes mood. One day, he's euphoric. The next day, he's depressed. The next week, he's panicking. Prices gap down. Headlines scream. Your account drops 25% and you're trying to be brave. And then real life taps you on the shoulder. Your hours get cut. Your rent goes up. Your health insurance deductible reminds you it exists. Your car needs repairs. And suddenly, you're selling assets at the worst possible time. Not because you're weak, but because you're human. This is where Graham's lesser discussed work becomes a secret weapon. Graham wrote about storage and stability, the concept that societies and investors need reserves, a granary, a buffer, something that keeps you from being forced into bad decisions when conditions turn harsh. In modern personal finance terms, it means you don't invest your emergency fund. You don't build your retirement plan as if the next 20 years will be smooth. You assume stress and you design around it. And you don't need a complicated bond strategy. You need a simple defense layer: cash reserves, high yield savings, short-term treasuries or treasury bills, and a sensible bond allocation depending on your timeline and risk tolerance. The point is not to maximize returns. The point is to avoid becoming a forced seller, because forced selling is the number one way average investors convert temporary market declines into permanent personal losses. Now, take a breath. If you recognized yourself in one or two of these mistakes, that's not a verdict, it's a diagnosis. And a diagnosis is useful only if it leads to a better plan. So here's the payoff I promised: a Benjamin Graham-style low-budget blueprint that's boring on purpose, because boring is what survives. Picture your strategy as 3 layers, not 3 predictions. 3 layers. Layer 1 is defense. This is your stability engine. It's your ever-normal granary, your emergency fund, your cash buffer, the part of your financial life that keeps you from selling your investments at the worst time. If you don't have this layer, you are not fully an investor yet. You are a future forced seller waiting for a random expense. Start by making your defense real, not aspirational. Even a small buffer changes your behavior. It reduces panic. It makes you patient. It turns market volatility into an opportunity instead of a threat. Layer 2 is your core. This is where most of your long-term investing happens, especially on a low budget. It's diversified, low cost, and designed for consistency. Broad market exposure through low-expense index funds or ETFs automated contributions, and minimal tinkering. This layer is the antidote to the modern market's biggest addiction, the belief that you must always be doing something. Your core is where you practice the most underrated skill in finance, letting time work. You contribute. You rebalance occasionally. You ignore noise. You don't argue with headlines. You don't negotiate with fear. Layer 3 is optional. Your Graham picks. This is the small slice of your portfolio you can use for individual stocks if, and only if, you're willing to behave like an owner. You apply a checklist. You look for financial strength. You avoid excessive debt. You demand a margin of safety. You write down why you bought it, and you accept that doing nothing is often the right move. This optional layer is where people usually start. But in the Graham blueprint, it's where you graduate to. And now let's make it even more practical with a simple monthly routine you can actually follow. Once a month, automate your contribution into the core. Don't negotiate with yourself. Decision fatigue is expensive. Once a quarter or even once a year, check your allocation. If your stocks ran up and your risk got higher than intended, rebalance back. Rebalancing is a quiet way of selling high and buying low without making prediction. When the market drops and fear shows up, you ask one question before you do anything. Am I being asked to sell because my plan is wrong, or because Mr. Market is having a mood swing? Because Mr. Market will always have mood swing. Your job is to have a plan. Now I want to return to where we started Sunday night. The small contribution, the phone full of noise. Here's what changes when you follow this blueprint. You still invest 50 or 100 a week. Your income might not change overnight. The market might still be wild. AI stocks might still dominate the conversation. Meme stocks might still trend. Someone will still brag about a crazy gain. But your internal experience changes completely, because now you're not trying to get rich fast. You're trying to avoid getting poor by mistake. You're not trying to impress anyone with screenshots. You're trying to protect your future self, the version of you who wants choices at 60, not stress at 60. You stop treating investing like a lottery ticket and start treating it like engineering. You build a bridge with extra support. You build a parachute with extra stitching. You build a portfolio with a margin of safety. And that's the point people miss about Benjamin Graham. His philosophy isn't just about picking cheap stocks. It's about building a temperament and a structure that can survive bad markets, bad luck, and bad moods, yours and the market. So if you're investing on a low budget, remember this: your advantage is not money. Your advantage is behavior. Avoid the 5 multipliers that ruin small portfolios. Don't chase hype as a shortcut. Don't leak returns through churn, hidden fees, and taxes you didn't plan for. Don't confuse cheap with safe. Don't ignore valuation just because the story sounds inevitable. And don't build a portfolio with no defense against real life. If you do that, if you simply refuse to be forced into stupid decisions, you'll be shocked how powerful small and consistent becomes over a decade. Because the market doesn't reward intensity, it rewards endurance. And endurance, in Graham's world, is not a personality trait, it's a design choice. This is Benjamin Graham Investing. If you want more videos like this, Mr. Market, margin of safety, defensive investment, retirement blueprints for real life, subscribe, and keep building the kind of wealth that doesn't depend on hype, on process.